Are we headed into a recession? A lot of people talking about U.S. recession. And what's important if you're looking to buy a house in 2025 or 2026 is if we do enter a recession, how is this going to affect U.S. housing? How is it going to affect housing prices, interest rates, and all that stuff? So what I want to do today, I'm going to look at the last 5 recessions, how those impacted U.S. housing, because usually a good predictor of the future is what's happened in the past. Lastly, I'm going to have some key takeaways. So stay to the end. Key takeaways from past recessions that might give us a clue or a hint on what we should expect if we go into recession and how that's going to affect U.S. housing. So first and foremost, let's talk about the early 80s. I'll show the graphic up here. I'll show you my notes just so you can follow along with me and see exactly what happened during future U.S. recessions and how housing reacted. So 1980s, early 80s, my parents bought their first house. High inflation, aggressive interest rate hikes by the Fed Reserve. We were in a recession, and what impact did this have on the housing markets? Mortgage rates soared to nearly 18%. And if you talk to somebody from the early 80s, I think my parents had a 12 or 13% first, an 18% second. They thought that this was a great rate. A lot of people in the early 80s, if you talk to them and the mindset they had, they thought interest rates would never go sub 10%. I've talked to multiple people that have told me that they thought that rates would never be sub 10%. Surprisingly, even though it was ridiculously expensive, imagine an 18% interest rate, how expensive it was to borrow money. Despite all that, home prices remained stable because inflation was high, even though affordability plummeted, as you can imagine, with 18% interest rates. As inflation cooled and interest rates fell in the mid 80s, the housing market rebounded. So no big crash. Now let's look at the early 90s recession. High oil prices, this savings and loan crisis you guys have heard about, tight monetary policy. How did that affect housing prices? Well, housing prices dropped slightly. And if you look at, historics, like a 2 or 3% drop in some markets, far from a crash, right? But prices were relatively flat or slightly down. It stagnated due to rising unemployment and really tight lending criteria after, savings and loan crisis. It was hard to get a loan. And I kind of compare this to what it was like trying to get a mortgage loan in, call it 2010 or 2011. Really, really restrictive, really hard. Home construction slowed due to decreased demand. And that's what's going to happen. When there's less demand, home builders are not in any position where they're going to want to build a lot of housing, which kind of stalls recovery. But in this case, the market improved in the mid 90s as the economy rebounded and mortgage rates continued to go down. All right. .com bubble recession, 2001, when we thought, computers were going to crash. When the clock struck midnight on 2000, everything was going to explode. Between the stock market crash that came, where all these, what was it, like pets.com or something? There's all these examples of these tech companies that were super overvaluated, right? So those crashed. We had the attacks, 9/11 in 2001, corporate scandals. Housing market barely slowed down. Interest rates were cut aggressively, and that probably had an effect that made it so where housing continued to trade. Demand for real estate actually increased, and I think that's probably that lever of interest rates can really affect demand. And you throttle down interest rates, you're going to see an increase in demand. So this is kind of what started that early 2000s housing boom. If you were, active or looking at real estate, or you've read or you've talked to people, the early 2000s and that run up to 05 and 06 was a wild time. Insane home price appreciation from early 2000s till, most markets probably peaked in 05, 06, depending on where you're at. Investors began speculating in real estate. And speculating is one way to put it, right? You've heard all the stories. Loans where you didn't need income. You didn't need a credit score. You didn't need really much of anything. People that had really no clue or no business owning multiple properties were buying 5, 6, 7 properties. And speculation is just saying, I want to buy it today for $250, hoping it'll be worth $300 or $350 in the future. Who cares what the terms are? Who cares what the payment is? It's going to be worth $100,000 more in a year. I'll sell it. I'll refinance it. I'll do something. That's speculation. That is danger. So the housing market never really weakened, and home prices kind of continued to throttle throughout this recession until, the fourth recession we're going to talk about, the Great Recession, 07 through 09. And this was caused by a housing market collapse, subprime mortgage crisis, and financial system meltdown. I mean, this was gnarly. And for those who've seen The Big Short and different, movies around it, there were so many components to this. Lending standards for sure played a big part in this. Just letting anybody get a loan on any property with damaged credit, with very little down, very little skin in the game. Wild times. And the impact on the housing market was, you saw after you hit a peak in 05 or 06, 30 to 50% price declines in some areas. There's Fresno, California, there's places in, Las Vegas, Nevada. You can point to some that just saw huge dips. I mean, quite honestly, even the neighborhood that I was in Sacramento, stuff that traded for $350,000 in 05 or 06, you could buy in 09 for $180,000. So that's a 50% decline for all intents and purposes, right? And so foreclosures skyrocketed. People were in terrible loans, and that was a really big piece of why people were foreclosing, was because if you're in a variable rate mortgage, you never had any business being in it in the first place, and qualifying wasn't even a thing. Millions of Americans lost their homes, and so it flooded the market with inventory. This is why prices, plummeted. Afterwards, lending tightened dramatically. And so, you had the easiest lending guidelines that we'd ever seen, where it was no income, no jobs, no assets, sign your name, and you get a loan for 100% of the purchase price. Like, it went from that to very, very, very difficult. And new construction plummeted. Nobody wanted to build. And so it was nasty. And really, as you'll see, this was the only time where we saw a big housing market crash. A lot of people know this one better than any other ones. They're like, oh, if we go into recession, housing crashes, prices go down 50%. Not really the case. It's the only time it happened. But the recovery, it took a while. Market bottomed out in 2012, and then a long recovery. Really, from 2012 through 2025, it's been a steady climb up, with a big bump coming in 2020, which is the final recession on this list of 5. COVID-19, pandemic-driven economic shutdowns were the cause. And the impact on the housing market for this recession was huge home price surging. And like I mentioned before, like, you throttle down interest rates, you're going to get a big injection of demand. And the problem with throttling down interest rates and inserting a bunch of demand is that we hadn't done the building over the last decade. So there wasn't enough supply to fulfill all this demand. So what happens when there's not enough supply to fulfill demand? Prices go up. And so prices went bonkers in 2020 and 2021 in almost every market across the U.S. You look at some of the Boise, Idahos, and the Austin, Texas, and Florida. Those markets were extra bonkers, and you're starting to see some retraction from that, especially in Texas and Florida. But home prices surged, driven by record low interest rates and a shift in housing demand, also driven by low supply, I think is something to add there. Remote work and stimulus checks increased demand. People had extra money. People were feeling pretty good. And the housing supply shortages led to bidding wars, right? I mentioned, the market remained strong through 21 to 22, but rising interest rates in 22 to 23 slowed down price growth. Price growth slowed down. The amount of transactions went from 7 million to 4 million. So really, the amount of transactions really slowed. And ultimately, we've seen a pretty flat housing market from, let's call it, the summer of 22, when rates started to go up, until 25. A lot of markets, you can put a dot on May of 22 and today, March of 25, and home prices haven't done much. They're pretty flat. Some markets have gone up, sure, but I would argue, if you looked at it, they're like up in the spring, down in the fall, up in the spring, down the fall, and overall pretty close to where those 2022 levels were. So those are the past 5 recessions. Let's talk about the key takeaways and what you should be thinking about if you're afraid to buy or excited to buy or have expectations around it. Here's the key takeaways to end the video. Not all recessions lead to falling home prices. That's important for you to remember as a consumer. Only the Great Recession, like I talked about, 07 through 09, saw a severe housing crash. All other recessions had, no price declines. The COVID era saw the opposite, right? Where home prices went up. Number 2 key takeaway from past recessions: interest rates matter. When the Fed cuts rates, the housing market often rebounds quickly. And so if we go into a recession and the Fed, in order to, stimulate the economy, like that's their tool, it's what they do. If they throttle down interest rates, that could have upward pressure on housing prices. And that could be something that causes more housing to trade. Number 3, unemployment is key. Of course, right? If job losses are severe, you're going to have less demand for houses. If less people can afford to buy, if less people are working, if less people feel good about job security, that is going to demand, that's going to pull down demand. And that could lead to lower prices. That could lead to people, unfortunately, losing their homes and foreclosures and the other stuff that adds supply. Add supply, prices can come down. Add demand, prices get pushed up. It's that supply and demand, like never, can you get away from the simplicity of supply versus demand affects prices. And keep an eye on that. All right, finally, housing supply affects outcomes. We all know this. When supply is tight, price drops tend to be smaller or non-existent, or the opposite happens where there's home price appreciation and upward pressure on prices. So you got to look at all of it. You can't just be like recession equals this. Housing supply is going to matter. Unemployment's going to matter. Interest rates are going to matter. Really, all of these things, in the end of the day, tie into supply and demand. So let me know what you think. If you're feeling like we've got a recession coming, what you think is going to happen to your local market. Again, different markets will behave differently, right? There's some markets that already have an oversupply of housing. They don't have a lot of demand, and those ones are going to see different dynamics over the coming years versus other markets with very little supply. There's still an abundance of demand. Those are the markets that could really be difficult for people to buy in if we start seeing lower interest rates and demand goes up. So let me know what you think. Talk to you soon. Bye-bye.